Hello, YouTube. Why are stocks only going up? Well, it's because we're tracking the pattern from 2020 where we went up by 50% and we're currently up by 20. So how much higher could we go? Well, I lay out a target that I posted at the end of last year, which says that we could go as high as 5,600. I also talk about exactly what I need to know that I'm wrong. We will circle back and talk about this, but unless it is 2,000, we have a 90% chance we're going to be higher. And the average return has been 16%, which takes us to pretty much that number. So this is very interesting. And the reason why stocks are going up is because that Magnificent Seven, the Super Six, basically big cap tech stocks, are going higher. And they delivered this week. So we note that week to date, we have Meta up by 20, now crossing that $1 trillion mark. Microsoft, Nvidia, Amazon pumping. Google and Apple are a bit of a flop, but so far the pack is dragging us higher. We just talked about how high we can go, which could be as high as 5,600. And there's some key catalysts coming up this week, notably that Jerome Powell's going to be talking, and then we have some bond auctions. So what's Jerome Powell going to say? It really mattered what he said before. And he's going to be speaking on 60 Minutes. So I think he's going to provide a lot of clarity in terms of the numbers we saw on Friday and the numbers that we in the press conference we saw with the Fed on Wednesday. We now only have a chance of 62% of a pause when last week we were at 56. Well, actually at 65. So it's only actually gone down by a little bit. So it's not exactly where they want it. And right now, GDP looks incredibly strong. So what does this mean? The interpretation of this means that as the economy grows, it is a very good clue for the S&P 500 earnings, where we're forming higher lows and higher highs on our quarterly GDP growth. And right now we're tracking 4.2%. I can't tell you how strong that is. It's incredible. So what that basically means is that we're currently going up, only up so far this year. But seasonally, between February and March, we do have a little bit of turmoil. I would also note that the pattern we talked about where we cross into extreme greed, lose it, and start pointing down, well, look at the image. It shows us that if we lose extreme greed, fall into greed, and then go lower, the odds increase that we're going to go back down to extreme fear. This time could be different. Let's just be very mindful of it. We also have some key levels we're going to review a little bit later in the show, but it basically means that we have about 5 points of upside to resistance, and then about 5 points of 15 points of downside back down to our annual level. So I think the risk reward is skewed for the bears this week, even though we're going higher. So what could be the warning sign, Justin? Because it sounds like you're being pretty pessimistic, even though we're going straight up. Yes, that's because we take the staircase up and the elevator down. So if you look at Bitcoin, we talked about this failed breakout pattern before, which was a very strong signal for us going down. And the S&P had that exact same pattern happen here. And so far, the NASDAQ is actually currently in a monthly failed breakout. So this will be the primary pattern I'm looking for going into the end of the month. And we just started the month. So again, stay tuned. And at the end of the show, we're going to go through some charts. But I'm going to ask you for a huge favor. If you could please consider smashing the thumbs up and subscribing to the channel if you're new here, I would really, really appreciate that. Thank you so much ahead of time. All right. So as we look forward to earnings for this week, I would say that these companies matter, but I don't really think they're going to move the needle because the mega caps delivered. And as we reviewed, if they're delivering, stocks are likely going to keep going higher. So this will give us a really good pulse on the rest of the economy, but I don't think they're really going to move the needle. All right, so there's our highlight. Let's talk about the key dates for this week. So trying something new here. Again, if you enjoy it, please make sure to drop me a comment and let me know. Monday to Friday, we have no critical reports. There we go. I just got to read it, Justin. All right. No critical reports, but a good pulse on the broader economy. Reminder, GDP is currently tracking 4.2 for the first quarter. That means these companies should be beating. If they don't, we're getting a false signal here. And then on Sunday, which is going to be tomorrow, Jerome Powell's going to talk 60 minutes. He's going to talk about interest rates, inflation. Let's see what he says, right? He's going to have a sit-down interview, prepared remarks, and I'm sure he's going to have his story crafted. And then we got the 10-year note and the 30-year note auctions coming out on Wednesday and Thursday. We're going to see whether or not there is bond market appetite right now. So I want to see what Jerome says. If you remember what he said before, too, is that if there is going to be a critical report, what'll sometimes happen is that the chair will actually see the data before it comes out. And if you look at the economic data that came out this week, oh my goodness. So it's really, really hot. So if we look to this week and we just zoom in here, sometimes when we have a big report like non-farm payroll coming out on Friday, the Fed chair will be able to see that data on Wednesday. I believe, again, not I know, but I believe that he probably saw the report. And that's the reason why he pulled that March meeting off the table, because he knew the data is going to be coming out hot and he doesn't want to appear bad. So I think that's what happened. What we also want to keep in mind is Warren Buffett's quote, where he tells us that the market is a device for transferring money from the impatient to the patient. So we will come back and talk about this pattern, but let's keep it so simple we can't ignore it. Higher lows and higher highs are bullish. So far, since our bottom, we've only formed higher lows and higher highs. So until that happens, we're probably going to keep going higher. And people might be surprised, but we went higher for 11 straight months back in 2020. That same thing could happen here. Is it a guarantee? No, there's no Justin 30-day money back guarantee. But here's where I'll tell you where I'm wrong. Let's zoom in to see exactly what I say here. We need to see a monthly lower low closing below the low. That's it. I posted this on December 30th of last year, and so far it's tracking. I didn't really believe it all that much when I posted this, but here we go. It's higher. This is our template. And we know that we don't want to fight the Fed. Pauses are bullish, and blue skies are also bullish. So there's one more thing that I wanted to make sure I made very clear here that I don't think I actually got through. So 62% chance of a cut. And then where's that image? I think I forgot to copy it over. So let's go to here. I'm actually going to do something on the fly. Hopefully you guys don't mind this. I've talked about this before, so let's just paste it here. Just give me 2 seconds, please, and thank you. Let me move this back down to Jerome so I can tell my story. I said I don't want to pivot. I want to pause. Why? Man, pivots aren't good. The Fed can lower rates for 2 reasons: because they have to, or because they can. Every previous time they've pivoted, they go all the way to the point where they break something. So right, they jack interest rates higher, something breaks, and they take them right back down to zero. That's just how it works. So why would this time be different? I don't know. Right? Jack him up, dump him down. Jack him up, dump him down. Every single time they jack him up, dump him down. Just like here, go to 5, right down to basically 1. Go to 5, go to 0. Go to 3, go to 0. Go to 5. Why are we not going to go to 0? I don't know. Is this time different? So even though everyone wants the pivot, I don't. I want the pivot when it's appropriate. Right now, I don't think it's appropriate. So what this tells me is massive declines could happen, and the telltale sign I will be looking for to confirm this pattern is basically just going to be this: the monthly fail breakout. So let's go through a couple more pieces of news, and then we will come back and look at some charts to make sure we really understand that the S&P can do this too. It did it before. It was a very accurate topping signal, and we don't want to ignore that. All right, let's just look at the card here and see if I missed anything else before we start looking at levels, because we know that 480 is the only number that matters. There's going to be lots of noise. Swap it out for this week, right? Economic data. There's strikes happening in the Middle East right now as a retaliation. There's going to be earnings, right? So what do? Let's focus on levels. We're over 480 and we're holding it. We are likely to be over 492 and we're still holding it, still bullish. And we talk about that area, which is 466. So very clear notes. Nothing has changed. And when we think about where we currently are on an annual basis, SPY has a green light for the annual chart and a green light for the monthly chart by being over 492. QQQ, however, only has a green light on the annual. And that's because we're currently just below 430 on the monthly chart. That's it. So we got a double green light for SPY, and we got a green light and so close to getting over, but not quite there. If we look at QQQ now, it's at 429.85. It's within 15 cents of getting over the previous high. And ironically, as I look at this, it's exactly on last month's high, 429.85. That's exactly where we are right now. So technically not a failed breakout, but it's 1 cent off. So let's close this out. If you would have told me what all this data was, I would have got whipsawed, because this data looks mixed. So we got a lot of data this week. So even though we know we have stuff coming out next week, like I mentioned, I'll walk you through it on the daily upload. So again, maybe you want to consider subscribing to the channel to stay up to date with everything I'm going to be going through for the rest of the week. Thank you for your support ahead of time. All right, let's finish off by looking at some charts. And let's try to keep in mind that we want to be like Warren Buffett. I think one of the best investors, and someone who, if we listen to him, we're probably going to make a lot of money, and it should be fairly easy. All we got to do is be patient. So what I want to talk about before we look at the charts just really briefly is what's been happening year to date. The market is definitely broadening out, but I'm noticing that there's still some pockets of like red, like notably financials. We got that New York Community Bank shock this week where the stock was down, I think 40%, because there's some concerns about a REIT. About real estate in their portfolio. Boop. Right. We got a big suck on regional banks. But so far the market's shaking it off, taking it in stride. At a certain point, I think we are going to have a corrective wave. But unless we form that lower low, I think we got to be constructive. So now let's go through and talk about this failed breakout pattern and what exactly that would look like on these charts. Let's go to SPY first. All right, so pause the video if you want to see the numbers. I'm identifying exactly where they come from. And again, keep this in mind. The recession is not yet confirmed. So we got the pause, then we got the pivot. So far, we just have number one. So let's be very patient. But if we look here to a failed breakout, it happened here exactly at 480. What happened? This market went straight down. So until we close a monthly candle below the previous candle high, we're expanding. What would that mean? The earliest that we can confirm this pattern is going to be February 29th because it's a leap year. So we can get an early warning sign, which means going into a yellow light or losing the previous candle high. Again, those are the numbers right here, right? We got 492 to 466. So as long as we're over, it's bullish. If we fall back below, now that's where we have the potential. We get a yellow light or a warning, and then we get a red light or bearish confirmation by closing the month below. That's it. It's that simple. Don't ignore it. Be patient. So on SPY, let's just look at the other charts now to get a better grasp on this, because what the S&P is trying to do is it's trying to do what the Dow Jones did. There were two templates we could have followed to go to new all-time highs. And again, let's make this really simple here. So we got our previous all-time high. We poke over it and continue higher. So what that means is that we're basically tracking what the Dow Jones did. If we look here, what do we got? New all-time high on first attempt. There's our previous all-time high. There's our new all-time high. And what do we have? We got higher lows and higher highs. That's right. So higher lows, higher highs, which means an expansion or we're pointing up. It's that simple. If we go over here to XLK, same thing as SMH. This is where we had resistance. That's right. So not really a failed break. It's more of it's actually technically a failed breakout relative to here, meaning this high versus here. I would kind of just call it a double top, but it's inside of a larger pattern, which is actually a cup and handle, which goes higher. But anyways, if we fail to hold the previous candle high, what we're likely going to do is something like this, where we look for up to 3 months of a corrective wave. We've talked about this before too. And this matters because from the time we formed the all-time high to the time we back test and held it, it was 6 months. Are you ready to hold on for 6 months and hope for the best, where we could go down and then maybe go back up? If you're not, be ready for it, because other charts, which are going to contradict the market going up, are looking pretty bullish. I'm not going to lie. If we look here to the dollar or the Dixie, we note that, okay, it's pointing up to, so US excellence, we've been talking about it. It's bouncing off our uptrend. We're over a key pivot from 103, which goes all the way back to 2002, 2003. And it looks like it wants to go up. It's currently at the high of the month with a higher low and a higher high over the candle high. And then if we look here to the VIX is squashed. No one's worried about any volatility right now. What does that mean? We're at risk of getting a bout of volatility, a shock to the system. I'm not calling for it. I'm just saying we're at risk if something happens. And then finally, because we have that auction a little bit later this week for the 10-year note, what's happening here? Well, we're also pointing higher. So let's look at this a little bit objectively, because we have the 50 MA that's about to cross over the 200. That's a golden cross. That signifies momentum. Do you see the momentum? Yes. Is it going to continue? That's the question. If this keeps going higher, it means that the Fed does not have inflation under control, or the economy is going to remain incredibly resilient, like we see with that 4.2% GDP print we just got. And as I mentioned, we're currently trending higher, but if we lose this uptrend, we could come back down to support, which is going to be roughly a 1% drop back down to about 3, which would mean that stocks are going to go up dramatically from there. So that's it for this weekend's video. I thank you very much for tuning in. If you want to watch my video from last weekend where I give a little bit more analysis, that's now queued up here on the left-hand side. If not, maybe you want to subscribe to come hang out with me through the market opens or to watch all of our videos. Thank you so much for your support.